Hello, everyone. Thanks for joining us. We'll get started in a minute. All right. So, a couple of pointers before we get started. The main topic today, of course, will be about DeFi. I know a lot of you in the audience are very interested in the topic. If you guys have questions, feel free to send questions through the chat and Q&A. We'll also have a more in-depth Q&A session towards the end, so feel free to stick around. We'll be sharing this recording of the presentation and the slides in our social media, in YouTube, Twitter, etc. So if you're not able to stay for the whole duration of the presentation, feel free to check it out later, share it, etc. And I think with that out of the way, we can get started. Awesome. So the topic for today is what's next in DeFi. At Into the Block, we're deeply embedded within this sector of crypto with our institutional business mostly, and working with the house more directly with our third and upcoming product. So we have a very good picture of what's going on within DeFi. So we'll analyze what's the current state of DeFi through a bunch of charts that we'll go through. We'll look at what happened in 2022, 2023, the new primitives and trends that have been developing and likely to continue on to next year. And finally, we adventure out with some predictions for 2024 based on DeFi's outlook. So before we get started, a quick update about Into the Block. We've been working very hard in this new release of our analytics product that we call Perspectives. We launched a series of dashboards. We're launching at least one new dashboard a week. So last week, we released one on liquid staking, which of course is a key component of the DeFi market. We'll go into it in depth, both covering the staking side as the governance tokens of these protocols. Feel free to check that out. And more recently, just today, we're actually yet to announce it, but a few hours ago, we launched the Arbitrum Incentive Program dashboard, where you'll be able to see all the inflows, the revenues, the TVL, what's the growth in the environment, which players are making the best return on those incentives. Very interesting analysis, so feel free to check it out. And of course, I'll include some of these metrics throughout the presentation, since they're quite relevant. Now, without further ado, let's dive into the current state of DeFi. So 2022 was a stress test for not just DeFi, but the crypto sector altogether. So I would argue that overall, DeFi held up quite resiliently. Despite TVL and revenues dropping over 80%, most of the blue chip protocols, so Uniswap, Curve, Compound, Aave, and a few others survived without major impacts or losses or collapses. Whereas you see some of the centralized counterparts like FTX and the lending companies completely collapsing. So in many cases, they were more resilient. And now we're going to be diving into the segments and how we can contrast the impact of the bear market between the centralized counterparts, the decentralized ones, and how the DeFi protocols have been growing since. So the first comparison is between exchanges that are centralized and decentralized. There's a few key differences, of course. The first and foremost is that they are non-custodial in nature. So something like Uniswap doesn't hold your assets, it's instead held in your wallet. Whereas in a centralized exchange, the exchange has access to your keys. So essentially, you're choosing between counterparty risk of the exchange properly managing the funds versus protocol risk whenever you trade or if you provide liquidity. So we saw this trade-off take action live with FTX, which of course collapsed and lost a lot of clients' funds, whereas Uniswap or Curve hasn't lost funds ever for people that traded through the platforms. In the case of liquidity providers, it can be slightly different. But yes, overall, we're seeing that competition take shape, and DEXs particularly stand out for long tail asset trading, which can be listed permissionlessly immediately after launch within DEXs. And so in periods of high speculation, we see very rises in the share between DEXs to SEXs. And in 2022, we saw the trend go down in terms of the market share of decentralized exchanges, but increase in 2023 as the market picked back up. The contrast between lending protocols and institutional lending companies is even more stark. A big piece of not feedback, but hesitation or pushback rather against lending protocols is that they're over collateralized and hence they're less efficient than what you can get in a centralized lending company or even a bank in some cases. That being said, we saw that this over collateralized system was almost empirically more secure, since lending protocols handled liquidations very effectively during the collapses of prices, and institutional counterparts, literally all three of the largest lenders collapsed and went to zero effectively. So Genesis, BlockFi, Celsius, those managed hundreds of billions worth of loans and are now bankrupt, whereas Aave and Compound were able to process liquidations quite thoroughly and effectively, and in short, were more secure. The one sector that didn't shine as much during 2022 were bridges, which were the worst hit type of protocol, arguably. They have lost the most across hacks. So about 2.5 billion between the hacks of Nomad, Ronin, Multichain, a few others. I think part of the reason is because they're one of the most complex types of protocols, so they have room for vulnerabilities. And there's now, it led to the concentration in now only a few players, like Layer 0, Wormhole, Axelar, dominating the space. And in 2023, of course, as I've been alluding to, we see a resurgence. So if I had to summarize DeFi in 2023 with one word, it would be resurgence, because we see not just market activity, but also fundamentals essentially pick back up and push the ecosystem forward. So we track here the market cap of DeFi blue chips, which roughly doubled this year. And as I'll get into, key demand and supply metrics for some of these large and reputable protocols have grown across the board. We also see the launch of new products from these existing protocols and newer protocols getting into the space, acquisitions from large teams, as we'll get into, and multi-chain expansion. In terms of multi-chain expansion, 2023 has been really about expanding to layer 2s. So layer 2s really played a minor role in 2022. But as we can see here from our layer 2 perspectives dashboard, the number of transactions have increased dramatically in optimistic rollups. So more than 5 times that they were 1 year ago. In November of last year, even more for the year altogether, since for most of 2022, transactions were quite low in layer 2s. And now, following the launch of Base and continued adoption of Arbitrum and Optimism, we're seeing essentially any blue chip protocol be available across multiple L2s. And we saw Base get its moment to shine during the summer, right after their launch. And now Arbitrum is getting a bit more traction and share in the past few weeks. So in terms of DEXs, decentralized exchanges really shined in May of this year. So we had the meme coin frenzy driven by Pepe and copycats of other new meme tokens that reached a lot of mindshare within the space. So that led to Uniswap V2, where a lot of these meme tokens trade. almost reached their highs from 2022. So I think about 800 million traded within a day compared to 900 in 2022. We saw, of course, something that I had written about and sort of predicted, that post FTX, a lot of people would go from trading in centralized exchanges to DeFi, as you don't have that custodial risk that we discussed. And because of that, partly we also saw in 2023 a new all-time high in terms of the market share of decentralized exchanges, surpassing 20% for the first time. And currently, with the recent rises in prices, we saw DEX volumes in November reach their highest since the Silicon Valley Bank collapse, which of course triggered a lot of stablecoin volume. Then in lending, we see loan demand recover and in a more sustainable way. So whereas in 2021, it was all fueled by liquidity mining incentives and a lot of token speculation, now it's a lot of real yields coming from real world assets, which we'll talk about shortly, and liquid staking tokens driving demand. So we see, for instance, a perfect example of this is Aave V3 launching on Ethereum, where they have zero incentives, and naturally they've been able to reach over 1.4 billion in loans within less than a year, growing quite consistently over time. And as I mentioned, liquid staking has a lot to do with that. Post the Shapella fork, we see the amount of liquid staking accelerate in April, and particularly in some of the smaller liquid staking solutions like Rocket Belief, which has been able to nearly double their market share, as well as Frax ETH, which is a new entrant, really take hold. So we see a lot of competition growing, and overall the ecosystem is seeing a lot of demand, which is one of the few sectors that is literally at all-time highs right now in terms of their fundamentals. And that competition has also led to Lido, even though it's been growing, as you can see here, quite significantly. Its market share has actually been decreasing as new entrants come into the space and offer new solutions to attract users, essentially. So their market share has dropped from 95% to 85%. And one positive note that doesn't get talked about enough is that we also saw in 2023 that the amount of hacks, and particularly the dollar amount, so the volume that gets hacked within DeFi, has really slowed down dramatically in 2023. I hope I'm not jinxing it, but we're on track to be this 2023, the year with the least dollars lost to DeFi hacks since 2020, when basically DeFi didn't really exist. So all in all, DeFi is getting more resilient. We're seeing fewer black swans. You know, we had a few like quite small ones, like Curve that got a minor exploit. Balancer had a vulnerability. That being said, they were limited scope, so only like a select number of pools were affected by this. And overall, the numbers lost there were a lot less than the billions lost in 2021 and 2022. And instead, we're seeing some of the more experimental companies really get hit, which typically offer more custodial services like the Telegram trading bots. We saw Maestro and Unibot get hacked, and some of the SoFi apps like the FriendTech competitors get hacked. I see someone's raising their hand, and we have a few comments. Oh, someone's asking. Actually, I'll ask and reply real quick. What happened in Q2 2021? Essentially, this was the Iron Finance exploit collapse, rather, that led to I think 2 billion or 1.5 billion in that one alone. I'm excluding Terra from this collapse since it would deviate the losses a lot. But all in all, losses in DeFi have been trending down, both from economic and technical risks. And SoFi is social finance apps, which essentially means like FriendTech competitors. We have some articles talking about that if you guys want to dive further. And now I want to talk about the new primitives that are taking hold in the space. and the trends that are sort of marking 2023 and likely to play a bigger role in 2024. I see I have a question, but I'll leave that one to the Q&A at the end. So I think one of the new trends that has really taken off in 2023 is the rise of real world assets. So what do we mean by real world assets? You can argue how descriptive the term actually is, but essentially means assets that are trading off chain, have a synthetic version of them on chain that is able to be freely traded like any token. It can be sent from here to South America with very low fees, and you can take advantage of that lower friction and faster settlements. And Maker has been really the pioneer of this trend. So yeah, I see some people think that this is exciting. I would agree with that, particularly because it has more the potential to be more broadly adopted within the traditional banking ecosystem. So we see particularly treasuries, so short-term treasuries that are now yielding 5.5%, be represented on chain through tokens like SDAI, SFRAX, or USDM. All of these natively earn the yield from treasuries paid off essentially by the US government and bringing demand into DeFi. You could argue, of course, they do have a more custodial nature since the bonds are held off chain. So it's less decentralized, but it's nonetheless very big breakthrough to bring more adoption and a cross intersection between the real world finance, traditional finance, and decentralized finance. And in a way, they've been equivalent to liquid staking tokens, since they also provide like a native yield for stablecoins to be earned on chain. So before, where you could have staked ETH as collateral in Aave, now you could also have SDAI, and in both cases, your collateral earns yield while you borrow, and it just brings a lot more efficiency into the system. And then, excuse me, there's one trend that we have been discussing in depth within Into the Block. Our CEO, Jesus Rodriguez, particularly has an article in CoinDesk describing it more deeply, which is a trend that is like unknowingly a lot of DeFi protocols are heading in this direction. And this article really describes the broadness of this trend, which is the path towards micro primitives, as Jesus calls them. Essentially, what those are more customizable, more modular approaches to each existing DeFi primitive. So, for instance, in DEXs, in exchanges, you have in UniV3, you have the simple trading logic where you have like a given number of fees currently, a given percentage of fees that are one time set by the pool, and people trade without any difficulty, really. And what UniV4 introduces with hooks is the customizability of these fee mechanisms, the MEV within these pools, the number of addresses I can trade. These can vary over time, so they're more customizable and more programmable. So taking in some of the advantages of DeFi to make it in a way more complex, but more customizable, with the ability to yield better outcomes. So you can think of pools that may start with a higher fee when there's less liquidity, and then fees can drop as there's more volume being traded, so that there's enough incentives for liquidity. So it'll be a lot more dynamic in the case of UniV4. Then we have the trend towards eigenlayer, which introduces the concept of restaking, where actively validated services, AVS as they call them, will be able to leverage the Ethereum staking stack and add extra functionality on top, so such that you're able to spin up your own protocol, your own layer 2, using EigenLayer and get extra advantages, introduce, that your validator set validates something else, just an Ethereum, and is able to add more security, take advantage of the Ethereum security, but also introduce newer functionalities. And that creates newer layers on top, leveraging that. So essentially, yes, it is allowing the option for more protocols to be built on top, which is what I mean by creating a competition in the layer above. So it can be either centralized companies competing for like creating the best UniV4 hook. It will probably be protocols in the case of EigenLayer competing for the, the restaking sector that's coming. And in the case of Morpho Blue, which is perhaps lesser known, they're doing the same approach of creating a base lending protocol where the liquidity is aggregated in the base layer and creating aggregators on top where they have the, I think they call it Morpho aggregators that have that liquidity and the risk parameters specified by each of them, essentially having a lot of markets on top of the layer market, competing one against the other in the hopes of attracting a more competitive ecosystem that will yield better results across the whole ecosystem, and also more expertise that can be personalized for each of these and that adjust more to their audience. So it's definitely something that's a bit complex in all three of these cases, but it's why we see institutions, both decentralized and centralized, competing in that layer on top of the micro primitives and adding layers of aggregation to simplify that then to the users. In the case of UniV4, unsurprisingly, they realized this, and they also announced Uniswap X, which will be an aggregator that will aggregate all UniV4 forks, UniV3, UniV2, etc. It will be like the layer on top, abstracting away all the complexity from the micro primitives and layers underneath. And quite frankly, I think this is exciting because it should lead to a better user experience and also competition in the middle layers, which will yield opportunities for institutions that want to participate there. And we see a similar dynamic play out within governance. So in the case of Maker, they've been pioneering a governance restructure within their endgame that they call sub-DAOs. It's one of the main elements. There's a lot of elements within the endgame, but one of the key ones is that there will be sub-DAOs within the broader Maker DAO, each of them specializing in a particular sector. So I think there's one for like marketing, and there's one for lending protocol like Spark. So, and there's the classic one for DAI, the collateralized debt position. And there's like, I think 6 or 7 that have been announced yet and more to come. And the idea is to delegate more confidence into each of these substructures so that there's less friction and they're more dynamically able to move and minimize in a way the friction and the governance involvement. This trend of governance minimization is spinning up not just within MakerDAO, but more broadly. There's this protocol, Ajna Finance, that also has essentially zero governance. It just adds more dynamically for lending. And we're seeing that across the space as we go into more pragmatic approaches in general, where there's less involvement from a DAO to be able to make faster decisions. And even then, like slight tangent, we were seeing some of the benefits that DAOs are even performing better than centralized institutions in cases like the OpenAI saga, ironically, in the past few days. Then I think lastly, the other trend that we're witnessing in 2023 is the vertical expansion. So we're seeing some of the more established protocols want to move closer to the end customers. And we're seeing this both from a wallet perspective and an infrastructure layer perspective. So from the wallet perspective, Uniswap launched their wallet earlier this year. And more recently, Aave announced through their restructuring of Avara that they acquired Family, which is another Ethereum wallet. So you see the companies behind these protocols take a step to move closer to the customer and manage that whole relationship. At the same time, you see the YDX go from settling on Ethereum to now settling trades within their own chain, which allows a lot more efficiency essentially for these trades to be settled a lot faster while still being decentralized, and them capturing fees, which are now paid in USDC to people staking. So we see that approach. Just yesterday, Blur announced that they're launching Blast, which is an L2 with native yield. So we see a lot more protocols, even those that are outside DeFi, spinning up more layer twos, and even roll apps, which are like app-specific roll-ups on top of the OOP stack and other layer two solutions. Again, I see a few questions, but I'll dive into that a bit later. Then we also see the return of liquidity mining and airdrops. So we saw Arbitrum earlier in the year, Celestia, Pipe just this week. So airdrops seem to be back in vogue and likely to play a bigger role into 2024. We see incentive programs returning. As I mentioned just 2 weeks ago, Arbitrum incentives kicked off. We have a dashboard diving into this in depth, but essentially we've seen the beginning of $50 million worth of rewards being allocated, which are essentially subsidies from Arbitrum to incentivize adoption of their protocols within their nation, following the metaphor. And within just 2 weeks, the TVL of Arbitrum has grown by 25%, and revenues in some of the protocols have spiked by 3x, 2x, 50%. And now we might run a bit over, but I want to talk about some predictions for 2024 to make it exciting for you guys. I'll probably formalize this a bit more in a blog post later. But yes, essentially, I think the key word that I would summarize what, taking in place everything that we covered, DeFi in 2024 is likely to head into a world of acceleration, where we see a lot of the protocols hit records in many metrics, and at the same time, some headwinds from the regulatory side. So let's dive into them. So one of the main ones that I predict is that decentralized exchange volume share will reach 50% for the first time, which would be as much volume being traded in decentralized exchanges as centralized exchanges. My reasoning behind this is that there's already the trend towards more on-chain adoption and trading. Fees are very competitively low in Uniswap and other DEX platforms. And there's also the catalysts of the ETF approvals, which seem very likely, the Bitcoin halving, the Fed pivot, and all of those are likely to create more demand for risk, and risk taken can take place faster within DeFi and decentralized exchanges. So I think we'll see probably new highs in terms of their market share there. Then I also foresee a on-chain credit boom, which essentially I can qualify as at least $10 billion in loans outstanding taking place right now. This chart shows only AVV3 on Ethereum, but I believe the number is around 5 to 8 billion. And I think it should grow by at least twice that, so 10 billion more. So right now the growth has been quite linear. I expect this to be more exponential as prices grow and demand for leverage grows along those collaterals. So people will inevitably take risk and I think repeat some of the mistakes of previous cycles, for better or worse. But we're likely to see leverage in general and lending protocols benefit as a whole, and also taking advantage of the real world asset yields and liquid staking tokens. Then I think one that we've been looking for altogether as a space for a while and might actually play out this year, this 2024, is the breakout moment for decentralized derivatives. Right now, they trade only about 2% of the volume. But I think with the infrastructure that just launched with the YDX chain and with the upcoming launch of Synthetics Perps V3 and Infinex, we're likely to see a lot more volume, like an order of magnitude greater, and also them take advantage of unique incentive mechanisms or lower fees to be able to compete and gain market share, particularly in a time where centralized exchanges are also going through some regulatory issues. Like we saw Binance, of course, lose 4 billion in settlement yesterday. So it's likely that decentralized trading, the move towards decentralized trading also reaches the derivatives markets, and within options as well, not just perps. We see IAVO launch their options protocol that has been doing quite well recently. Then we see liquidity mining on airdrops continue to grow, but slightly differently. So I think the main reason why this is the case is because there's competition. There's a lot of protocols, a lot of projects launching, and there is at the moment limited amount of users within the space. And also all of these projects want to attract new users into the space. And honestly, the best way to do it is through a product that attracts users, and might not be the best way, but one easy way rather is to add incentives on top to be able to financially attract users for a discount. And this is a playbook that has been applied by companies and now is being recreated within crypto. So as particularly with layer twos and eigenlayer restaking taking off in the past few months and likely into the next year, these will most likely have their own incentive programs that will be shaped, in their unique ways and drive more demand into the space. I think we're also likely to see centralized companies that have crypto products start incentivizing those products on chain through DeFi, and we're likely to continue to see points-based systems bring adoption into the space, as popularized by Blur, but also expand beyond the existing crypto bubble to other users that are attracted by these gamified incentive systems. Last but not least, to add a bit of darkness at the end, I think we're also likely to see more regulatory crackdowns. So you can see as the case that Binance just paid of over 4 billion being the budget for the regulators to go after more enterprises in crypto, more projects. And they're essentially, I think, recreating in DeFi a similar approach to what they did in centralized exchanges, where they start with the smaller projects and rise onto the bigger ones. This year, they already started going after some of the smaller, like very, very small DeFi protocols, and they're likely to move their way up the ladder to bigger and bigger protocols. I think there'll be a lot more resistance in this case because of the decentralization approach, and lobbying from both sides, both from like traditional banking and regulator side, pushing to crack down on DeFi, but also from the VCs in crypto that have multiple billions invested, pushing against that in the argument that they are more decentralized and have shown to be more secure in 2022. So I think though we will likely see acceleration of demand and a lot of key metrics of fundamentals in 2024, there will also be tension growing with the establishment, a bit of entropy and chaos, and a contrast where we're likely to see meme tokens go 1,000% up, while DeFi is getting cracked down by regulators. So all in all, it should be exciting and volatile, but we're trending in a positive way. None of this is financial advice, of course, like with any other of these webinars. But I appreciate you guys tuning in, hearing our thoughts. And now we'll go in our next webinar, we'll cover more in depth some of the key trends in 2023 beyond DeFi. I know we covered some of them in DeFi, but we'll expand to NFTs, layer ones, what's happening in the infrastructure layer, VC investments. So we'll cover those in the next webinar. Make sure to sign up for that one. We just shared the link there, so make sure to sign up. And I'll be sticking around for some questions now. I feel like I went real quick, by the way, but had a lot to cover. So pardon me if I went quickly. I'll be able to go back into some of these topics. So a question that was asked a couple of times is what SoFi means. It's a new term. People in crypto like to add fi to a lot of things and just make it more financialized incentives. So friend tech is the main protocol in that case, which is essentially like a paid group product where you're able to trade access to these groups. And there's different takes on that, but essentially adds financial incentives on top of social apps, hence SoFi. Then someone's also asking, could you go deeper into Telegram bots? Particularly, I was talking about Telegram bots for trading. So like Unibot, I think was the first one to gain adoption there. I cover it here a bit. No, not here. So essentially, you have like a strategy where you choose an address to follow, or you want to auto trade new tokens that launch. The Telegram bot holds your keys, which is the main pushback, but also is able to automatically execute strategies that you just described. So it does add a lot of convenience, but they charge fees and they hold your keys. And unsurprisingly, they've been hacked a lot. Someone's asking what protocols we included in this chart of real world assets. I believe it's MakerDAO, Ondo Finance, Frax, both in MakerDAO and Frax, just the real world asset section of the whole protocol. Ondo Finance, USDM, and I think I'm missing one, but those are the main ones. I think MakerDAO holds like 50% of the market. Okay, a few more questions. So Pierre is asking, what do you think about centralized limit order book DEX adoption? Cosmos with Injective, Vega, Hyperliquid, and DYDX, and Solana. They're testing a centralized order books DEXs that seem to be ready for the next DeFi summer. So I'll go to the slide of like the DEX volumes reaching 50%. I think it's proven essentially that limit order books are more efficient to settle trades, and they can bring forth better prices for entities and users trading. We see some examples of this. I believe in Solana, Orca uses a central limit order book while combining the liquidity provision like an AMM, which I find quite interesting. And that has been the exchange with the largest volumes in Solana recently. And within Ethereum, it's more complex to achieve because every transaction would entail like a transaction fee. So we haven't seen it take off in Ethereum, but I believe in newer chains and most likely in layer 2s and soon enough in layer 3s, that central limit order books will make a comeback on chain. And it's part of the reason that I think that DeFi volumes will reach 50% market share. At the same time, we will also see DeFi routing orders off chain. So Uniswap X, which is an aggregator, will have the ability to route orders off chain to market makers that will act like recreate their own types of order books off chain and be able to match orders and compete for the best pricing. So even if Uniswap V4 is not having an order book per se, this Uniswap X aggregation layer will have a similar logic that I think will be drive order of magnitude of more efficiency. Then one more question, and I'll wrap it up. Someone's asking what's my Twitter account. I have it here at the end. It's just my name. Oh, we shared it, but that won't be the last question. Don't worry, guys. I think we have one more. Glad you guys have liked the presentation. It also seems like DeFi. Sorry. So Pierre is asking, since DeFi protocols have to manage risk more tightly than centralized exchanges, there won't be competitive fees and rates on DeFi protocols compared to similar products on exchanges. So I think that's in an argument of why DeFi might not surpass centralized exchanges. I would argue that is not really the case when it comes to decentralized exchanges. The risk management layer is outsourced to the liquidity provider, same way as a market maker in a centralized exchange. In lending protocols, it is a bigger factor, the risk management, which is why we're seeing that the more modular approach that I covered in one of these slides. Yeah, but I think the risk management layer will essentially be settled at a layer on top. Like I mentioned with UniV4 hooks, will likely have companies competing for the best type of pool that they create and like have fees on top of that are customized and have their own algorithms on top, similar to market makers on centralized exchanges, and be able to compete more on par. And in the lending layer, we'll also have risk managers on top of the base layer liquidity, competing to offer the best services that can offer low trading fees for users that want low borrowing fees for users that want access to leverage. So all in all, I think we're likely to see more demand of these protocols and more competition in 2024. So I've rambled on enough. Thank you guys, all of you that stayed for the whole duration. I appreciate the thoughtful questions, and we're excited to see you in the next webinar. So make sure to sign up. Thank you. Bye.